G'day folks, welcome back to another update for high-grade copper, which continues to rise, and US crude oil, which is showing a slight retrace in a downtrend also. Now, I've got some back testing to show you as well. Before we go any further, make sure you hit that like and subscribe button to support the channel. Looking at the outlook for US crude, after a 7-week decline, prices have slightly rebounded, with West Texas Intermediate closing at $67.18 per barrel, influenced by ongoing geopolitical tensions. The US Energy Information Administration forecasts that WTI will average around $60 per barrel in 2025, with potential fluctuations between $40 and $100 amidst global demand uncertainties and sanctions on major oil producers. For high-grade copper, prices have surged over 20% in 2025, reaching just under 4.90 per pound, primarily due to proposed US tariffs leading to stockpiling. Analysts are divided. Some predict a price decline in the latter half of the year as US import demand softens. We anticipate a longer bull run driven by tariff concerns and electrification efforts. So first we start with high-grade copper. We look at the long-term trends as always. So on the monthly, the price is above these moving averages, and they're in the description below if you want to learn how to draw those on your charts. So when the price is above those moving averages and the moving averages are trending up, that's a bullish signal. Likewise on the CCI 150, that's also broken above its moving averages, giving us a bullish signal. So bullish on the monthly. On the weekly, likewise, it's been bullish now for a number of months since the start of the year. Nice big strong bull run, and currently there's no sign yet on the monthly or the weekly in terms of a pullback. However, notice on the daily, that's also bullish on the above the moving averages on both the CCI and the price. But notice we've got a bearish divergence. Now it's only early days yet. That CCI is starting to potentially turn down. Lower highs on the CCI versus higher highs on the price. It's a bearish move, and we're likely to see a retrace. Now, if I was to draw a Fibonacci in terms of where it's going to land, if I took it back to that recent low before that divergence started, you can see there the first area we might look at would be this intermediate area of the 23-38% level, between that range there. But if we took it back even further to, let me just to that low, you can see there it's that range will be slightly lower if I was to draw another range. So it depends really where you want to draw the Fibonacci's. They're a bit subjective sometimes, but I like to take it back to the immediate significant low, which would have been that area. But sometimes it does fall a lot further. So that'll be your initial target, is what I'm trying to say, if the Fibonacci falls to that point. Otherwise, if it goes, take the Fibonacci to there, that'll be the wider target. So at the very least, we expect it to drop down to this level, assuming the price continues to drop in line with the CCI dropping. Now, if we go to the intraday charts, we see if there's any micro moves there. And what I mean by micro moves, you can see here we've got another bearish divergence on the 1 hour chart, higher highs on the price versus lower highs on the CCI. And similar sort of story, we've got this one's a bit tighter. We've got a Fibonacci range before that divergence started, and it's already broken through to the 50% there. I won't draw the target range, but if you take it back to that level, you can see it's already touching that 23% level. Okay, so that's where it is, and that also corresponds with this previous resistance, now a support at 48.79. So that's where we are. It's a bit of a pullback there. So again, if you were going long, remember the weekly, daily, and the monthly are trending long. However, I'd like to see this reverse and start on the hourly at least, start moving to the upside, and preferably break through those previous highs to be more bullish. So just wait for that period to start before taking any long trades. Don't take any short trades. Remember, the rule is you always trade in the direction of the higher time frame. So if you're trading on the 1 hour, you want to see the daily also in a bearish move like it was during this period back there. So what we've got here is the daily still. I've got the 1 hour time frame, and what we've got here is the back test. The top chart here shows profitability for the stop loss program, and this shows the profitability for the average down approach. And each of these averages down, we start with one contract on the stop loss only. We don't average down on the stop loss. And the average down, we start off with one contract, then double that, and that creates 3 contracts, and then double that again. And we've got there now 7 contracts, and it maxes out at 15. This one doesn't go as high as 15. It maxes out at 7 contracts 3 times. So what we look at here, I've got the back test starting when the daily, and that's on the 1 hour, the daily opens long positioning on that big candle there, and that was the 5th of March, which corresponds with this period back here on the 1 hour. And you can see there over the whole period, that generated with a baseline of 100,000, but it generated 1,531 for the stop loss program and 9,437 for the average down approach. Now you'll notice here we got stopped out a couple of times and it dropped down to almost break even on the stop loss program. And this one, with the average down approach, it actually had a bit of a drawdown almost to the break even as well before finally recovering and breaking and closing out at a higher profit. Now the reason you would have taken close your positions, ideally, if you're really strict with the process, you would have closed your positions when that daily broke into that moving average range. And that would have generated, if you look at the 1 hour chart, it would have generated $64 on the stop loss approach, the top chart, and $253 on the bottom chart. I'd avoid going and holding on to it too long because this could continue to drop, in which case, especially on the average down, you're going to be really hit hard if that goes against you. So you want to make sure you stick to the rules, and whenever that breaks into the moving average range on the daily, you close out your position. Okay, in this case it recovered, but again, don't get greedy, follow the rules strictly. This is US crude. Again, on the monthly, we're still bearish. It's been fluctuating in that range for a number of months now, actually a number of years, and it's still bearish currently. It's been that way for a few months. And the CCI is also broken down below the moving average range. So bearish movement on the price and the CCI on the monthly. On the weekly, likewise, below the moving averages. And there's no sign of a divergence or a pullback on the monthly or the weekly. And on the daily, it did hit this resistance up here at 79.60. And since then, it's actually dropped and been bearish since then. And it's been bearish for the whole period, with the exception of a bit of a retrace there, but that wasn't enough to go long. And currently we're in a neutral positioning. Whenever you see the price or the moving average enter the or the CCI enter the moving average range, we avoid taking long or short trades until we see a more decisive move one way or the other. In this case, if the CCI breaks below that moving average range, we'd start taking short positions again. So don't be fooled by the price still below the moving averages. You want to see the CCI move in that direction as well. There's no divergence to speak of on the daily. Now if we go to the intraday charts, the 1 hour chart, again, predominantly short trades during this period. So you would have taken some short trades there, and I'll show you the back testing in a minute. But at the moment, let's see if we got any divergence. You can see there the price and the CCI are moving in tangent. There's no divergence to speak of. So again, just wait for the daily to break very likely below the moving averages to start taking short positions on the 1 hour time frame if you're trading the intraday time frame. So this is the back testing for US crude. So I've got the 1 hour time frame on the right and the daily on the left. Remember, the rule is we always trade in the direction of the daily. So in this case, predominantly short positions. And what I've got on the back test here is starting at that position back there on the 21st of February this year. And that's indicated by this period here. You would have taken short positions, and up here we've got the stop loss approach. And that if you kept it in for the whole period, and I suggest you would have closed it out at that point there. Let me just mark it to show you on the graph. If you want to strictly follow the rules, at that point on the 2nd of March, which coincided about that point there on both. So you would have closed out there on the stop loss approach. You would have closed out with, what's the profitability on that? Doesn't show us, hang on. Yeah, 2,895 versus 8,069 on the average down approach. And then you would have opened up another short position there. Let me just mark that there. And you would have opened another short position there. And you would have closed it out at that point there on the profitability on both. So at that point, you would have closed it out there, and that was marked by that point up there on the stop loss approach. So this is assuming you ran through the whole process. Obviously, you would have stopped trading there and reopened the position. But that one there, if you let it go, generated 4,779 for the stop loss approach, and for the average down approach generated approximately $8,082. So at the moment, you would have closed out your positions and wait until, as I said, wait for this CCI to break below to start short positions, or if you're going to go long, wait for the CCI to break higher, but also wait for the price to also break higher. And ideally, you want to see the moving average band on both the CCI and the price start curving up that way, like it was back here, for example. That was a false break, for example. Long positions on that because the moving average band on the price is still in a downtrend. Okay, so make sure you want to see the moving average band start curving up like it did back here. To support the channel, hit that like and subscribe button, and for added benefits and for a cost of a coffee each month, consider subscribing to the Patreon page where we look at weekly scans of bullish shares across various regions Thanks for watching and see you in next week's video.